If you're a first-time home buyer, you're probably out there saying, okay, I know I need my down payment. I know I need additional closing costs. I'm struggling. I have the income, I have the credit, I have everything else. I just need help or assistance getting into this program. That's why a lot of grants were created. So what we're talking about today is UWM. The UWM just came up with a program, and this isn't the best thing since sliced bread. These programs like this have been around for years. Okay, I just want you to understand that. Here's the UWM just announced 0% down purchase program, and here's all the guidelines: who's eligible, who's not eligible, and all this other stuff. So what I want you to understand is this isn't uncommon. Okay, but what happens is the media, and they take this data and they run with it, and they're going to try to skew this in a way that's completely negative, like they always do with things. So what I want to show you is CNN just did an interview with a professor. Okay, what he's a professor of, I don't really know. He's going over this program, trying to explain it to everybody, and you can see he's trying to create fear in this. So let's get over to it. Let's watch this video, because I want you guys to understand the UWM program, and I do have an alternative to this thing. He is right. This is, you're getting a first and second mortgage. Yes, that's correct. We have basically the same program, but it isn't a second mortgage. It's basically money given to you as a grant that's forgivable. It does not need payback. You don't have to wait until you sell your house. You don't have to refinance at some point. It is completely forgivable. So I'd like you to check that. I'll give you the link to that here after this video. But let's get over to this so I can kind of walk you through what he's saying, so you guys understand this as we're going along. So let's make sure we're at the beginning. So let's get through this.
Okay, so Professor, can you explain how this program works, and does it make you nervous?
I'll answer the second question first. Yes, it does make me nervous.
He's nervous.
The way that it works is it's geared toward first-time home buyers, and the Fannie Mae has a program where it will purchase loans that have a 97% loan-to-value ratio, meaning that the loan is equal to 97% of the home value or the home purchase price. And what United Wholesale Mortgage has done is it's kicked in the final 3%, which means that the purchaser of the home and the borrower of the debt doesn't have to pay any down payment. So they have no equity in the home from the get-go. And the way the program works is UWM, or United Wholesale, will have a second loan that they make to the buyer, and that second loan will then be repaid when the home is sold or refinanced. And the first loan, which is up to a 97% loan to value, that mortgage is sold to Fannie Mae and goes through the traditional channels of typically being sold into the secondary mortgage market.
Okay, so I mean, what's dangerous about this setup, or what worries you about it? And is this like what was happening in 2008?
So it's not like what was happening in the sense that there were many other actors involved in the problems of 2008, but this is one component, a very important component, where it does begin to look like the erosion of underwriting standards.
Okay, so we got to address that part first. What happened? What created 2008 crash? Okay, one thing, and he says it's right down here: subprime mortgages. This isn't a subprime mortgage. Okay, what subprime mortgages were, here is the typical loan back then. We called it liar loans. Internally, it was what was technically called a NINA. NINA means no income, no assets. So you didn't have to prove your income, you didn't have to prove your assets. Those loans aren't even available anymore. So when he comes out and says, well, the underwriting standards they're saying are a little bit tighter, they're tons tighter. Okay, so that's the first piece of that equation. The second piece of this would cause the subprime mortgage crash is the people that took out their loans had a teaser rate when they started. So it was a rate usually about 2% lower than the normal rate out there at the time. And then it also only consisted that you only had to make an interest-only payment. So those went on for 2 or 3 years like that. Then all of a sudden, what would happen is your loan would fully amortize, meaning now not only do you have to pay interest, you have to pay principal. So that would cause a lot of mortgage payments to basically double. And then you got rid of that teaser rate. So the rate went from, a 2% less than where it should have been to now the normal rate. And that caused many, or in some cases, house payments to triple. So in today's market, we don't have that. I think there is a very small fraction of people with an adjustable rate mortgage. And I don't even know if there's any subprime mortgages left at this time. So want you to understand the context of what he's going through. And again, this professor, what he's a professor of, I don't know, but he should know these things.
Now, United Wholesale has said that underwriting standards are much better than back in that period. They are correct. But one of the primary underwriting standards is how much of the home value is being purchased with debt. And typically you keep that at 80%, not 100%. And the lower, the better in terms of safety.
Okay, so let's talk about that for a second. You have two loan types that are guaranteed by the federal government: VA loans and USDA loans. Do you put down 20%? No. 10%? No. 3% like this program? No. You don't put down anything. So you can get a VA loan or a USDA loan with no money down. So it is not untypical for people to not put any money down. Now, I agree with him. The more money you put down, the more, the more equity you have in your house and so forth. But again, let's just let him keep talking.
So in this case, going to 100% is unusual and it's relatively high. Secondly, these loans are geared toward individuals that make 80% of the median income in a particular area. So they're being targeted toward those individuals that cannot accumulate a down payment, which seems appropriate, but those individuals also.
So he says they're being targeted. So basically, if you look up the area median income in many areas, it could be $80,000, $90,000. So that's not somebody making minimum wage. Okay, so then he's going to come about saying, well, these are people, if they miss a paycheck, they're going to lose their house, job, house, cars, everything. Well, I mean, how many friends of you that you have own a house and still live paycheck to paycheck? So I'm not saying it's good, bad, or indifferent. What I'm trying to do is explain to you guys, how the shock and awe of mainstream media really works. So let's keep going through.
Also can't withstand things such as a temporary loss of job or other disruptions such as a major health expense, and they're more at risk of losing their home as a result. So I think that the problem here is that you're targeting an instrument that is really not as safe as it should be for this particular type of borrower.
Okay, so that's the video. So what do you think? So let's start going through this. He says we debunked the 2008 thing where he says, 2008, it was, the underwriting was, fairly similar to what it is today. It's nowhere close. Okay, so now let's get to that 97% thing they talk about. Fannie Mae created this thing. Let me show you. This isn't anything new. It launched in 2014 when Fannie Mae came out with their 3% down program. Okay, so this has been around for 10 years now. So let's now look at the delinquency level, or let's look at the LTV levels of homes that were purchased going back to, this is as far as it goes, folks. So I'm not trying to cherry pick my data. I go to max, and that's basically where it is. So you go all the way here. Here's the typical loan to value. And remember, the 3% thing came down into effect right through here in 2014. So previously, this is where we were. All right. So since 2014, yes, has LTVs gone up, and you're still seeing 80%. So it's still under 80% if you go all the way out to the end of, in Q4 of 2023. So it's a small percentage of loans that actually get into these grant programs. And if you really dig into the delinquency levels, look at the delinquency levels of USDA and FHA that don't put down, or VA that don't put any money down. They're very typical to, where the average delinquency is on any mortgage at this point. So there's what you see through the data right through there. Here's an alternative. Here's the alternative that I have for you. Go to the rateupdate.com. Here's our website. If you want to find some grant programs that might really work for you, here's one that's fantastic. Well, we have a grant finder. So what you're going to do is you click the grant finder. It's going to launch you out to this system right here. I've already done it. So you go through here and you answer these questions. So let's go down and answer the questions. In this case, I'm going to say, so what we're trying to do is we're trying to find you a grant that beats this other one. Because remember, the UWM was a second mortgage. I'm trying to find you, is there any money out there that's free? You don't have to pay it back. You don't have to wait to sell your house to pay it back. You can refinance without having to pay it back. So here it is. Let's get through it. So the first thing is we want to go through this grant finder, and it is just me applying for a loan. My credit score, I'll say my credit score is 740 just for kicks. Go down through here. I'm a first-time home buyer, and I live in Chicago. So right through here, Illinois, it's in Chicago, so I'll put yes. Now here's the kind of confusing thing. You're going to have to find out the geocode of the area that you live in. So you're going to hit geocode, and you're going to come out to this thing. Okay. What I need you to do is put in your address right up through here. And I'm not going to go all the way to the top to show you the address. I just picked one in Chicago. I didn't use my own address. And you're going to copy, you're going to go down the bottom to this, and you're going to copy right through here, the census tracking code, the GeoID code, which exactly says right through here. It's all spelled out. So then you take that tracking number, you put it in here, and then you answer 2 more questions, and there they are. Okay. Then it's going to come down here and tell you what grants do you qualify for. Here it is. This grant right here is fantastic. It'll give you $7,500. So think of this. It's 3% of a down payment. That's what Fannie Mae requires. All right. So what does 3% come out to be? Well, you can actually buy, in this case, I did the math, at $250,000. If I got $7,500 in free money, I can actually buy a $250,000 home with no money out of my pocket. Okay, so basically it's a much better alternative than the UWM's 0% down payment because they're actually giving you 2 mortgages. Ours is going to be a grant for $7,500 that you do not need to pay back. Same thing with this over here, the Purchase Plus program we have. So what this is going to tell you, it's going to give you 3 programs that you don't have to pay back. It is not a second mortgage, and how you can find payment relief. So my name is Dan Frio. I do this report on a daily basis. If you want to learn more about what we do, how we do things, check out other videos I do, but check out our website. Here it is. The grant finder's right up there. And if you go down through here and you do qualify for this thing, what you're going to do is, where did it go? Let's go to Grant Finder. Okay, you're going to just hit the Apply Now button. What's going to happen? It's going to launch you right to my account. You're going to create an account here. I'm going to get an alert that you created an application. I'm going to give you a call. We're going to go through any questions that you have and put you on the path to buying your first house, possibly. So that's what we're here to do. But my whole goal today was basically to debunk a lot of just the doom and gloom stuff that's out there on a daily basis. So I hope you find value in this video, folks. And if you do, all I ask you to do is one thing. Just subscribe down below. Help me out and have a good day. So thanks so much for watching, guys. God bless. And we will have a live event later this afternoon. Hope you can join and ask any questions that you have at that time.